There just is such a knowledge gap out there. I mean, I have something happen to me. I bet it still happens to you a lot, where I will talk to people and they say something like, well, I don't want to earn too much money this year. I'll go from the 24% tax bracket to the 30% tax bracket. And they act like all of their income is then going to be taxed at 30%. So they don't want to
Uh,
earn too much.
I'll tell you a
So,
funny. So I'll tell you a funny story, Keith.
yeah.
So I used to teach a class every month, and we'd have anywhere from 30 to 100 people in the class. And I'd always do an example, and I'd say, okay, let's say that you earn X amount of dollars and you get a $5,000 bonus. What's the cost of that $5,000 bonus from a tax standpoint? And I would say a good 40% of the class would come up with about $8,000 was the cost of the $5,000 bonus. It's just like you say, well, that puts me in a new bracket. Therefore, all my income is being taxed in the new bracket. No, it is progressive, meaning the last dollar you earn is taxed at the highest rate, but the first dollar you earn is taxed at the lowest rate. Okay. And that's important distinction because we're never taxed on more than 40% of your income by the federal government. You just can't be. So you can make, $1 million a year, $1 billion a year, $10 billion a year. Your maximum tax rate is 40%.
And that's an epiphany to some people to learn that tax rates are progressive, like you just explained with that $5,000 bonus example. Tom, why don't you tell us about another tactic or another example like that? We have a lot of savvy listeners. A lot of them already realize that marginal example. Can you give us another one about how there's something relatively simple that can really elevate one's understanding like that and lower their tax rate?
Yeah, let's go to the flip side of that. So if the last dollar you earn is taxed at your highest rate, the first dollar you deduct is deducted at your highest rate.
Great point.
Right. So this is why, by the way, and if you read my book, The Win-Win Wealth Strategy, I talk about this in chapter 8. I used to say for a long time that you never got a permanent tax benefit from putting your money in an IRA or 401k. And I ran the numbers in Win-Win Wealth and I was wrong. That's not true. And the reason is because let's say you put in $10,000 a year for 30 years. Okay. That deduction that you get for that $10,000 you put into your IRA or 401k, you get a deduction at the highest tax bracket. When you start pulling the money out, you're going to pull it out and you get all the tax brackets. So you put the money in, you get a deduction at the highest. You pull the money out, you get basically the combination of the different tax brackets. So you are actually better off. So for example, if somebody says, I want all my investment to go on in the stock market, I would say you need a 401k. That is the answer because the self-directed would be best. Absolutely. Because you get a deduction now at your highest tax bracket, but down the road, you're going to pull it out. Basically, even if you have the same income, you're going to pull it out at a lower rate. Now, that only applies if you're going to put the money in the stock market. If you're going to put the money into real estate, a 401k is a terrible idea because real estate's a tax shelter. And you lose all the tax benefits of a tax shelter if you put it in an IRA. You actually take a tax shelter and make it a tax expense by putting it into an IRA or 401k. So there are certain things you would never do in an IRA or 401k. Real estate is one of those. Energy is one of those. Business is one. Agriculture. You never do those in an IRA or 401k. That's a terrible idea. But if you want to invest in the stock market, the bond market, things like that, IRAs make all the sense in the world.
You can watch this one next.